September is here, the 2nd of September. This Friday's webinar is actually going to kick off what we may see in September. It's Adrian, who's doing to CryptoBirb, fresh new holder of the CMT charter. I'm super excited for it because there has been tons of work and tons of changes and tons of unpredictability in this year. However, we keep pushing and sustaining this overall long-term trend in our personal growth and the company. And at the same time, despite the bear market, the crypto winter is here and it does persist. Potentially, there is a glimpse of hope. There is a ray of hope towards the end of the year. If you guys are here to tune in for what may be coming in this week and the next month, make sure you stay tuned. We are going there right in a second. Welcome, welcome, welcome. I think everything should be all fine on my side. Please let me know in the comments if you can hear me, see me well. As always, please, I do appreciate it. We don't want any sort of screw up so that the voice quality just is gone at times. Esteban Gonzalez says, good morning to you. I hope everybody is doing okay. Feel free to drop in the comments, say how you guys are doing, where you're writing from, what is the weather up like. I'm really curiously and genuinely interested how you guys are doing, and I do hope you're staying safe. There's a lot of unpredictability, a lot of geopolitical risks and tensions, lots of different strange times and diseases. Unpredictability is the key word on my side. In 2022, tons of unpredictable changes that I would have never thought of in 2021. But the year we are here, and we are talking about one of the definitely strongest bear markets in cryptocurrencies, one of the most violent retracements in the bear markets in the stock market as well, right? So tons of different kind of novelties popping in, and yet we should all be ready for it, and perhaps we can make a little bit of advantage of this. There's Will saying, good morning, sir. Good morning to you. Good morning to lovely Florida. Great Utah, amazing US. Love the spot. New York City, love it. Well, definitely keep them coming, and feel free to drop in some comments and kind of questions, guys. I'll do my best to answer one or two at the very end of the show. I would definitely just go and push right forward, to show you guys, well, that we are off to a start after fairly negative returns in August. We lost about 15%. In August, so it was definitely negative. Historical returns. This is the historical returns on a monthly for Bitcoin, just for instance, on the Bitstamp data exchange ever since 2011 shows you that the August is fairly the only negative return, kind of out of this entire data set, right? September is somewhere approximately around 15% on average, right, for the returns. However, the average performance, the historical performance are here. However, the average monthly return, is somewhere around minus 0.6%. September is definitely not the strongest month it can get. We definitely see a lot of weakness, a lot of underlying, I should say, seasonality as well coming. In not the strongest, not the strongest it can get as well for the stocks. S&P 500 closed higher than it opened from 2003 to 2022, only about 60% of the time in August and only about 60% of the time in September, right? And the seasonality is slightly skewed in favor of the bulls. However, you can tell that there is this overall valley. There is rather weakness rather than strength, right? This very bottom and the depth of the weakness performance, aside from January, which tends to be bearish for 55% of the time and bullish for about 45% of the time, right? So I would argue that having not so much of a bullish tailwind, to let the markets grow, we are really facing a lot of opposition, a lot of strong forces really pulling the headwinds towards us, right? So giving it a deeper check into the markets, we are really talking about the industrial average right now, piercing, through the right at the gap open, to the upside. We are talking about this overall potential pullback towards the 50-day trend, which got broken. This 50-day trend breakdown is something that I would consider as a pending weakness sign much more than anything. And in all honesty, we are looking at the strong curve and the strong inflection of the 20-day trend as well, with the 200-day trend continuing to be bearish for the industrial average. The composites are, of course, a little bit more aggressive, with this difference that they didn't even manage to kind of like climb as high as the industrial average as a whole. We didn't manage to even get closer to 200-day average. Same or similar goes to S&P 500, which has just attempted its bounce and a follow through to the upside around 4,000 points after rejecting the 200-day average at 4,300. So long story short, if I keep looking at this chart, the consumer discretionary, which is a cyclical stock, which leads this overall sector rotation phenomenon towards the bull market, right? When we want to talk about the bull market, there is no way we cannot see consumer discretionary pumping in there, right? And instead, when we see a lot of weakness in this overall bear market, then arguably we are looking at the bear market situation, and any stronger bounce can be considered rather a rally within a bear market, or a bear market rally as we know it. Consumer staples, of course, remain relatively stable around here, around 73, 75. The energy is, of course, keeps soaring with, despite local pullbacks. We're still talking about an ascending 50-day trend, ascending 200-day trend. So it's fairly opposite situation to what we're looking at the risk assets. So while stocks are pushing, up a little bit over in the overall bear market, this is the fairly opposite case for the energy. It's pushing up, or it was falling and now pushing up within the bull market, right? So it definitely makes you think whether or not the bear market is ready, that is finished, the bull market is ready. It does seem that it's not yet ready. As long as the utilities remain strong and they trade, around the all-time high areas, and this entire market performance is driven by the recessive stocks, being the defensive stocks on the consumer staples, on the healthcare, on the utilities, and strongly dependent on the energy prices, then I would argue that we are still looking at the recessive environment that typically aligns with the bear market for a little bit longer. Then having a look at the bonds, which sink lower, right? There's this heavy decline as the 20-day trend on the 30-year bond prices actually just keep soaring, keep plunging more beneath 133 points. Right now, the TNX, which is the 10-year yield index, you're looking here basically at the strong breakout after this failed head and shoulders, right? So the head and shoulders is a failed pattern. Actually, it broke to the downside, but then it didn't really manage to stay right there. It didn't manage to follow this perfect breakdown and retest sequence. Instead, it actually missed the follow through. It actually bounced right off the low, committing to a breakout failure, committing to a swing failure. And as such a pattern, broken pattern, failed pattern, tends to perform better in the opposite direction than anticipated. So if we are looking at this breakout to the downside, and we could anticipate, that there is going to be downside follow through. However, if it reverts upwards and surprises the shorters, the delayed bears, I would argue that this makes them cover their short positions, pay back higher, and at the same time accelerate the failure rally even better. So I would argue that in the yields, we may see even push outside the head and shoulders top over 3.5%, if you will, especially that aligns with the long-term agenda for the yields, for the interest rates, right? So I hope it makes sense. Vito Lux says, greetings from Italy, much loves to you, to goes back to Italy. Grazie. And make sure, guys, that if you have your questions, feel free to pile them up in the comment section. I'll do my best to answer some of these at least. So like I said, the seasonality is not really supporting or favoring either, like the entire quarter three, if you will, as a whole, right? While July tends to be at 75% stronger than weaker, 75% of the chances. This frequency, I can remind you that frequency means, or is considered basically the probability within a sample. And here we're looking at this valley situation. So as long as we're looking at August and September yielding about 60% of the months closing over the higher than they opened, which means bullish, then it means that 40% is basically closing bearish. It's somewhere closer to the neutral stage, right? It's within this neutral territory, as opposed to April, which tends to be the strongest month, typically yielding 80% of the time closing higher than it opened. for the 20-year data cycle here. Then continuing this research, I would argue that we're looking at a very strong dollar breakout, right? And as long as we keep looking at the strong dollar breakout, which persists through, which continues higher, then this definitely puts a lot of question marks for any potential rally, for any potential, I should say, bull thesis. The reason is that expensive dollar typically is correlated or associated with bearish price action and with overall recession. The expensive currency limits the amount of exports and imports, basically limit the amount of trades. As a whole, in total, the volume decreases, and at the same time, there is less earning for the company, for a state, for the company that the state is. The state is huge business, right? So when the trades are cut, it cannot really grow. It doesn't really have as much oxygen as it needs to breathe properly and to grow properly and sustainably. So here, really looking at expensive dollar, it discourages definitely the dollar investments, in terms of the purchases, right? That it makes you buy this less if it's more expensive naturally. At the same time, this expensive dollar attracts a lot of investors and traders who would withdraw the money out of other markets in order to put the money in stronger trending market. In this case, it's a dollar. Definitely such a strong monthly breakout to the upside in 109.68. Some are getting closer to 20-year highs from 2002, right? That's what we are talking. This is not an everyday casual situation. We are talking about once in 20-year situation, once in generation, if you will. So then, taking forward the overall performance of the main critical sector ETFs, then, like I said, we're looking at this leading performance from the energy, a little bit of a curve up, on the utilities and on the consumer staples. So we can tell that the three top performing assets of this year ETFs are energy, are utilities, and staples. So these are typically bearish, kind of like bear market, peaks, if you will. The energy is more expensive. Whenever the energy spikes very highly, which it did earlier this year, it brings recession. Whenever the inverted yield curves come up, it typically yields a recession as well. So here, being in a recession, being in this overall, economy shrink, if you will, despite it may not be the most violent, shrinking you've ever seen, it still commits to overall slowing and a process of economic cool down. So here, expensive energy prices, big and expensive energy expenditures, basically makes you poorer, right? This money runs out of your pocket and flows into energy, which it works as a hidden tax, if you will, right? So this hidden tax takes away the money, the disposable income you could otherwise spend in the investment markets on investments in the financial trades. So for this reason, having this definitely, recessive environment, I would argue that it's not safe for a lot of risk assets. And the risk assets traders, whoever believes strongly and attaches and dows to risk assets, to risk on trades, to Bitcoin, to other risky takes, as the stocks, cyclicals, S&P 500, and so, then I would argue that the odds are against. I'm not talking about today. I'm not talking about the next day. I'm talking about the year-to-date situation, which basically corresponds with 3/4 of the entire year almost. So here, seeing that, again, perhaps we can get a little bit of a glimpse into the 5-day relative rotation graph, RRG. And this RRG basically and virtually shows you that there is this sector rotation on the 5-day basis. And this sector rotation moves, from improving to leading quadrant for the dollar and for XLE, for XLP and XLU as well, and XLV is improving, right? So there is this entire upper right corner, rotation corresponds with defensive stocks. So over 5 days, the way you read it is there was defensive sector rotation towards defensive and against offensive stocks, right? So you can tell the biggest underperformer against the interception point, against 100 and 100, is basically Bitcoin USD at the very lagging quadrant in the very right left bottom corner. At the same time, there is a lot of weakness in the consumer discretionary and technology. Real estate is not really looking best. Communications is a little bit improving. However, there is clear direction away from the risk of from the risk on assets and toward the risk on. Hang on, I'm confusing that. Toward risk off and away from risk on. Nobody likes risks over the past 5 days. That's what the market tells you. That's what this chart tells me, right? Dollar, energy, utilities, staples, basic materials. This is not looking good for the risk assets for Bitcoin as well. And based on this momentum principle, which basically corresponds with a phenomenon that outperforming assets will continue to outperform. So outperforming, which is dollar and XLE and utilities and staples. Well, the tendency is that such a trend persists, right? So you could expect that this outperforming asset class is going to continue to outperform, while the underperforming asset is going to continue to underperform. So this sector rotation is nicely shown, here. I would argue over the past couple of days, right, for how it may look. You're just looking at this nice phenomenal situation where what the sector really rotates, right? Like I said, away from the risk on towards the risk off, right? You can tell here a couple of days ago when the market was peaking, there was this improvement. There was this leading kind of like preceding signal of dollar, of communication services, of staples, of healthcare, basically moving from lagging to improving quadrant, gaining on strength, gaining on relative strength, gaining on relative momentum. And if we go further, right, you're going to see how it transitions and moves to the leading quadrant, as opposed to the cyclical stocks, to the consumer. There you go. Basically to this, to the green tails, XLK and XLI. So Bitcoin doesn't really benefit from it really well, I would argue, right? So take a look how it actually rotates, right? I think it's very apparent. This is something that we call a sector rotation. It's a pretty cool tool, by the way, to visualize that. Then taking a look at, okay, for some reason it just keeps appearing. I have no idea what it is. MacBook is playing tricks on me. Regardless, we are truly looking at the situation where for Bitcoin is trading at 2371, and how does it all connect with the other asset markets? Like I said, the point is that there is a strong correlation. 0.54, it is basically what it was. 0.53, 0.53, 0.54, basically is a fairly strong relative dependence on Bitcoin against stocks, against the S&P 500. And I kindly remind you that this is the correlation coefficient on a 7-week basis. So here you're looking at on the last 7 weeks, the correlation coefficient between Bitcoin prices and S&P 500 movements is at 0.53. It's negative. It's positive. It's definitely, perhaps not as positive as it was a couple of months ago. However, it's still strong and positive, which means that whenever stocks move up, Bitcoin will tend to move up. However, this dependence has decreased a little bit. So you could argue that when the stocks move up, perhaps Bitcoin may move up a little bit less, or move at times occasionally in the opposite direction. Here overall, having this case with it's sort of like a bear flag, I would argue, right? There are two consecutive bear flags. One here between $40,000 and $50,000, and the other here between 17, 18, and 25, right? We did not manage ever to catch up with 200-day average, which shows a lot of weakness for Bitcoin, and instead we failed at a preliminary run for the rally, right? So it kind of like, again, puts Bitcoin at risk that even if stocks keep improving, then Bitcoin may even keep dropping lower. Right? I'm not saying it will happen. I have no idea. I have no crystal ball, no idea what's going to happen tomorrow. However, based on the historical records and average, this lets you set and fair expectations. An average over a large sample of data, large set of data, basically is a nice proxy to understanding the expectations. And having this downwards breakdown right beneath this lower ascending up trend line, it makes you think that it kind of like, is a form of a downwards break, right? So unless there is this last resort pump and rally to save Bitcoin, I would argue that the chances are that we may actually repeat a little bit of this downwards tail, following the very first pattern. So here, getting the chances for a potential breakdown already being there, I would argue that the Bitcoin bulls need to be really, really cautious. It doesn't mean it cannot pump. Like I said, if there is some restless or buyer, if there is some exceptional change and Satoshi Nakamoto appears to be Elon Musk and he candidates for president of the United States, some other country, I don't know, and they're going to rely on cryptocurrencies and vote in favor all around the globe. Perhaps it's going to have an immediate impact, news-driven kind of like a rally. However, it's likely, it's unlikely to happen. Let me know, guys, if so far what I'm saying is fairly understandable. I know there's a lot of nomenclature and a lot of complexity in this. Will Boiter, sorry if I mispronounced that. Know that your offer is great, appreciated. Thank you so much. Will, I'm happy you're actually joining. Vaughan Tyler, hi from South Africa. Hi, back to you. Sorry if I mispronounced that. Your name. So quality content, Agnes Aga. Thank you. Thank you for your. Thank you so much for your hard work. Rajesh saying valuable info on the markets, Birb. Thank you so much, everybody. Feel free to drop your questions. I'll do my best to cover one or two. I still have a couple of more minutes to go. However, the final take, about cryptocurrencies is something that you have to acknowledge. Like I said, for this year's performance. So let's scroll back to the very beginning of the year, so that we have year-to-date data, and you are looking at the very fair case that at the very top of the performance there is at minus 15, minus 16%. There is TRX to USD, right? And fairly, this is kind of like the top leader of the year so far. It seems it didn't suffer as many drawdowns or as much drawdowns to the downside as other markets, with Bitcoin being currently about 55, 56% year to date, right? So definitely not the best performer. I'm a little bit surprised still that there is this persistence in the way that TRX kind of like secures its own price, that it's less volatile. And the dollar prices, you're looking strongly at, of course, USDT being the best, being the very best performer, right? So it definitely paid off the best to stay in USDT for the whole year so far. It would have yielded you 55% of a profit instead of loss. TRX is up 40% against BTC. Then there is XMR, to USD. XMR kind of like against the Bitcoin price, there is 22%. And then we're looking at BNB and other sides to the game. And having a look at a little bit of a shorter term chart, I'm going to to get you guys a little bit of insights, of what it is that you're looking at. Fairly, this is a current time frame trailer setup of the BirbicatorPRO. This is my personal custom designed trading system that I use on a daily basis for my trading. And for any sort of like trading decisions, trading considerations, that's what I do watch. It promotes trends. This is a trend following system. I'm a position trader. I'm a trend follower. So every single position I have, I take. It typically assumes that there is going to be this longer trail in the market that develops, right? At times you have to wait for it. My favorite time frame is 12 hours, in fact. And plain just look, at it gives you truly the look at the stop level at 21,463. 21,463 is the level that bulls truly need to get broken. They need to reclaim it in order to play a little bit of some powerful games. Until then, we are truly deviating with some space to rally potentially to this resistance. However, the very first move is breaking truly above that 20,500 or 20,700. This is the two resistance kind of like a region that over which only Bitcoin can get a little bit more push to 21,500 approximately. And the very first successful close that you see Bitcoin closing on a daily time frame, higher time frame, on a daily, weekly closing through 21,500, I would argue that this may revert the chances in favor of the bulls in the short term, right? So the way I read it right now, ever since failing to hold 23,165, that was the very previous support level that could not be broken in order to push the bulls higher. But it eventually did end up being broken. The bulls failed and the bears took over the control, pushing the prices lower, pulling the prices lower. Right now, having this major resistance at 2600, 2700. Only after this gets broken, there is a little bit of a potential thrust rally towards 21,500. But this still means that even if we get there, even if we get this short-lived rally, and if it does get rejected at here at 21,500, then Bitcoin is still under the control of the bears. And it still may happen that you're going to see a little bit of an overthrow and potential downside continuation, right? I try to avoid making the predictions. Of course, I was wrong many times in the past. And well, I truly discovered on my CMT journey that trading is not about making predictions. That trading is about finding a reliable, robust system and following it. And that's exactly what I'm doing with the Birbicator Pro on my side. And here, having this resistance, like I said, until it truly gets broken on a high time frame, until you see a weekly pierce through and a weekly close through over 21,500, you can memorize that. Then only until then, or after you get there, only after you get there, truly we can be talking about bulls gaining back the control. Until it happens, the bears are in control. The bears have the upper hand and the upper vote, and it may happen that you're going to see a little bit of more downside pressure. I'm not ruling out such a situation where we would break the lows. Potentially 17,500 again is of course very low. Historically, Bitcoin tends to reverse and pull off, the retracements to about 80 to 90%. The maximum drawdown of the peak is about 80 to 90% peak of the bull market to the trough of the bear market. So far, we've seen 75% of such a move, right? So it still marks a little bit of potential to a downwards continuation, somewhere in the 10 to the 14,000 territory. However, if it happens, I cannot tell you, but you have to be ready for it, in my opinion. Hope it makes sense, everybody. And finally, when we go to the birbnest.com, I want to invite you guys to take part in our 7-day free program. We have the birbnest.com on the sign up free button at the very upper corner, the very up. You have a sign up free button, which gives you, with your email and with your first name, free membership and a full look into what's going on a daily basis for many years inside the exclusive Nest Club program, which is worth a lot of money a month, and it's going to get you guys this for free. So go ahead, set it up. I'll get your email, get your first name, and if you want to consider yourself a serious trader, if you want to improve your trading free of any charge for 7 days, this is the offer for you. However, if you are planning to goof around, that's not the best place for you, and you're probably going to be expelled. So this is only for serious people. This is only for people who want to learn behind the closed doors, who really struggle to find reliable information, because that is exactly what they're going to find in there. They're only reliable information coming as well from me as a charter market technician, the only charter market technician from Poland. Guys, I hope you appreciate this very stream. Let's have a look if we have any questions. The very last question, how do you manage your risk? From Adam Varda. Of course, this is a very broad question, and there are 1,000 books on that topic a lot, but most important point, I guess, is to define your risk preference. If you have defined your risk preference for if you're risk averse or risk neutral or risk seeking, then you can truly decide if you want to risk 1 or 2 or 5 or 10% of the account at one trade. The rule of thumb that yields the biggest stability and the best practice is 2% of a position, so that the position takes no more than 2% of your account when it's lost. That is something about the risk management, a very short, simple guide. More details in the birbnest.com at free trial. Feel free to go in and try it out. Guys, this has been a pleasure talking to you. I really hope you're staying safe and warm where you are. Beautiful greets, love the weather, being very good for where you are, and I hope you appreciate this stream. If you do, make sure you hit the subscribe button, smash the like, hit the notifications bell so that you stay notified whenever the new content comes up. We get this daily for you. Stay safe, guys. I think it's done for now. It's been CryptoBirb, your host, Audience Doing Trick. See you guys around. Bye-bye.